How much money could a high credit score save you on a mortgage? What up? You got Mr. Smith, point five of Mr. and Mrs. Smith. And in this brief video, I want to talk to you about how having a high credit score can save you when it comes to your mortgage. Now, before I go into that, if you want or haven't got access to basically the case study I did talking about how to go from being a renter to a home buyer, click that below and go ahead and get access to that free video content that I think will serve you well and put you in a different mentality in terms of buying that home. And if you do it the right way, how we recommend, if we decide to work with one another, then not only can you save money on your mortgage, but you can buy your home the right way and possibly have equity built into your home. And basically all that means is this: when you buy your home, it's worth more than what you paid for. Most of the time people buy their home and it's worth less than what they paid for by the time they buy it. So that's a whole nother conversation, but click that link, get access to that case study. It'll serve you well if you follow all the way through and we decide to work together. That being said, now, as it relates to high credit score and how it can affect your mortgage or how it can save you money on your mortgage, how much money can it save you? Well, it depends on how much house you buy. But either way, no matter how much house you buy, a high credit score is going to save you the most. Now, I know you constantly hear, or you may have heard if you've been looking, that a 620 credit score, FICO, is all that you need in order to qualify for the home. Now, you got to think about that for a second. Because a lot of times, yes, you can get qualified for a lower score, but that doesn't necessarily mean that that score has your best interest at heart. It's kind of like some of those buy from here, pay here car dealerships. We approve all credit, all credit types. Yeah, they'll get you in the car. And depending on your circumstances, it could be perfect. So I'm not here to say that you shouldn't do it, but just understand the risk that's involved when you do it. Because at those places where you buy a car and they approve all different credit types, you actually end up paying sometimes double or a strong percentage more than somebody else who would have bought that car that had a higher credit score. The same is true for your mortgage. Now, the interest rates on a home aren't near as high as what it could be on a car note. However, the years of time that you're paying to buy the home is more, which means that you can end up paying substantially higher than somebody else who bought a home that cost the same amount, all because your credit score was lower. So I'm going to give some brief examples. Let's say, for example, you did go ahead and get a mortgage, and let's say that your credit score was 620 or a little bit better. Okay, great. Say you bought a home for $100,000. Just an example, and many people buy homes for more than $100,000. Many people $200,000. But let's just use $100,000 as an example. Say you bought a home for $100,000. When you buy a home for $100,000 and you have a 620 credit score, let's say that your interest rate is 4%, give or take, depending on how the market is going, yada yada. 4%. Now, that might not seem like a lot, and your mortgage payments might be $470. Let's just say your mortgage payment is $470. And it could vary depending on your down payment. It's a lot of different hidden variables. But let's just say it's $470. Let's round up and make it $500. $500 a month for your mortgage with a 620 credit score at a 4% interest rate. Now, let's pause there. Let's say someone else had a 720. So they were in the 700 range. They had a 720 FICO score, which is how we purchased our home. We had over 7, score or whatever, and it was an easy process. But let's say you had a 7. Let's say the interest rate for that person was 2%. Now, I know it's just a 2% difference, but those percentages add up when you think about monthly and then over the course of 30 years, because many people get a 30-year mortgage. Here's what happens. If you're paying, now with that person who might have got a 2% and they had a 720 credit score, their mortgage might be $350 in comparison to your $500. Just throwing some numbers out there. $350 in comparison to your $500. So they're paying $150 less than the person who has a low credit score. So let's just call it me and you. Say you got the high credit score. You're paying $350 for your mortgage on a $100,000 home. I have the low credit score. I'm paying $500 with a 4% interest rate. I'm paying $150 more than you're paying. over the course of 30 years. When you do the math on that, I'm not going to do the math on it this time, but when you do the math on that, that could very well be over 30,000, probably over 40 or $50,000 more than you are paying. I end up paying $30,000 to $40,000 more on a home for the same price, same sticker price, in the same neighborhood as you, even though we live in the same area, got the same amenities and access to different things, all because your score was higher. So I want to ask you this question. Even though you got approved without your score being, where it could have been, was it worth getting approved for that home knowing that you're going to pay 30,000 plus more than you had to? Was it worth it? Was it worth it? Because you could have owned that home sooner and saved that $30,000, or at least had that in equity in the home had your credit score been better. So be mindful of that, because I know a lot of people get approved at lower amounts, but the higher your score, the better the deal, the sooner you can pay it off, and the sooner you can have equity in it, and it's just a lot of leverage. And if you get access to that free case study where I talk about how to go from renter to home buyer, then, I allude to certain things on how we purchased our home and bought it with some equity in it from the beginning. So hopefully that makes sense as it relates to your credit score, the importance of it before you buy your home, and the higher the better. Don't settle just for the 620. Yes, they can approve you for it in many cases, but you got to do what's right for you, not what just suits the person who's telling you that all you need is a 620. So consider all of those things. Now, I will say this, and this is just a bonus. Let's say you really know you want to get in a home as soon as possible for whatever reason. Great. There is a time during your stay in your home that an opportunity might present itself, similar to now where interest rates are very low, where you can refinance. And even though you might have got in the home and you're paying more, or you're paying more for a home that somebody with better credit is paying, when you refinance, you kind of can level the playing field. The past year or two, or whatever, however long you've been in your home, you might have been overpaying a little bit, but now you got your credit up. You've done some good things. You've elevated financially, and you decide you want to, do a refinance, and now you can position yourself to have more equity, have less in terms of a monthly payment, but still make the same type of payment so you can pay your house off sooner. So that's that. There are always ways to still rescue you from your own choices. So don't feel bad if you make that type of choice, or if you do make that type of choice, but just understand the options that exist. That being said, get your credit score up if you haven't already. Click the link below so you can go ahead and get access to that free case study. And if you want our assistance with helping you restore your credit, make sure you set up a free consultation or free credit breakthrough session so myself or someone on the team can help you restore that credit. And that being said, you can have a higher score so you can save yourself thousands, tens of thousands, sometimes hundred thousands off of just having a high credit score. That's all I got. Mr. Smith, signing out.